Another episode of Millennial Money Matters with Kelly Turner
and Derek Mazzarella.
All right, Derek, what are we talking about today?
We are talking about investing.
Ooh, this both excites me as a conversation and terrifies me.
It should.
It should. It's one of those topics that I think as a millennial is probably one of the biggest unknowns for a lot of people. And I feel like there's a great divide in millennials that either people are totally in this world and totally get it, or they're like, la, 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 la. They have their fingers in their ears. They don't want to know about it. They're just stuffing money in their 401k and hoping for the best.
Yeah, I find that a lot. And it's interesting because with the internet, you think, oh, well, we've grown up with it, right? So we I could just go on Yahoo Finance and learn all about all this stuff. And
yeah, but that's even more confusing. You Google investment strategy, you look up, even we were joking before we were recording about stocks and bonds being one word. And I think a lot of people just think stocks and bonds are one thing, and they don't necessarily know that. A stock is very different than a bond, and they have different purposes. But what are they, and why do I want them?
Yeah, I mean, I honestly, so if you feel like, wow, this is a really basic question, congrats. If you are nodding your head saying, yeah, I'm with you, Kel. I have no idea what those things are. Congrats, because I answer that for clients probably 2 or 3 times a month, right? Wow. So what's a stock and a bond, right? So let's start with the stocks then, because everyone loves stocks. They're sexy and fun. But basically, when you're buying a stock, you're actually buying ownership in a company.
So I own a part of Amazon, if that's the stock that I bought. I own a little bit of it. Can I walk in and be like, yo, what up? I'm your boss?
Yeah, you say get out of here. Or if you could actually find a Whole Foods, then just go, all right.
You're all fired.
Yeah, give me this lemon right now. No, so you're owning because there's millions of shares of Amazon, right? So if you own a share, you're owning a very, very
little nugget,
itty bitty piece of Amazon, right? But the nice thing is, the way stocks work is because you own ownership of the company, you're going to participate in their profits. And if they don't do as well, the stock's not going to do as well either. So it's going to be a reflection of revenue, typically over the long haul. Over the short term, stocks can be a reflection of kind of what's going on with the narratives. So narratives and vibes actually do matter in the short term. As you kind of saw with the AI trade over the last, year plus, people have just been pouring money into AI, and that's been helping the stocks in the short term, even if there's no actual revenue there yet.
Wow. So with a stock, right, you're buying a little bit of ownership in a company. You own this little bit of the company. Can you get anything else for that? Is there money that comes back to you? What does that look like?
Yeah. So some stocks, most stocks are in categories, right? So there's typically 2 main categories of stocks overall. There's growth stocks and there's value stocks. So growth stocks are really just going to say, hey, look, we think this company is going to be worth a lot more money in the future. So let's say it's worth $1 now. We think it's going to be worth $7 later on. So those are going to be companies like Amazon, Nvidia, all those kind of things that back in the day grew a ton, Tesla. And then there's the value ones, which are generally more established companies. They've been around a while. They think, hey, look, I think this is worth $1, but it's trading for 70 cents now. So there's that hopefully price appreciation there. But they do pay things called dividends. So to answer your question, a dividend is when they say, hey, look, we have extra money after the end of the year or a quarter. Instead of when we don't have a good investment option to reinvest in, let's say, a new building or something. So we're going to give the money back to you.
Oh, so this is like when you're playing Monopoly and you land on chance and they're like, congratulations, you made $100 on stock dividends.
Oh,
That's why you get your money back.
That's
in Monopoly.
How you get your money. Yeah, they're just returning profits back to the people that own the company.
Cool. So it doesn't all go to Jeff Bezos and his many yachts.
Most of it does, but
a little bit might come back to you.
Some go back to you for sure, yeah.
Now, should you buy stock in companies that you like? I love Disney, so I'm going to buy Disney stock, or I'm an iPhone user, so I should buy Apple stock. Is that a good strategy in purchasing stocks?
The studies say it's kind of a mixed bag with that. It's kind of because I see that advice all the time. It's buy what you know. Hey, I know Amazon. I love Amazon, or I love Apple. Really? I've got everyone in the world I know has an iPhone. If I see anyone with that green text thing, I get so mad because
curse you in the group chat. Curse the green bubbles in the group chat.
That's me. I'm a green bubble guy.
All right, my husband is too.
But so it can be effective to a point, but doesn't just because you know the company and like the company doesn't make it a good company to buy. I don't know, maybe like sticky notes, right? But doesn't make 3M the best company in the world to buy. So you really want to be very careful when it comes to buying your companies because they're still going to look at revenue long term. They still have to be a profitable company. They still have to have a good business model. All that stuff you still want to look at. And all this is way overwhelming. You probably you're better off buying either a mutual fund or an ETF, which is a collection of stocks.
A collection. So it's a whole bunch of, are you picking the stocks in that collection? Or are you saying okay, in this mutual fund, I want to have Apple and Disney and, Amazon, or somebody else is doing that for you?
Someone else is doing that for you. So you have an investment manager typically doing that for you. So I guess it's probably, we can talk about this in the thing, but there's 2 types of kind of mutual funds or ETFs, basically. There's active managers. So they're actively choosing one company over another company. They're choosing Coke over Pepsi, for example, right? So that's what they're trying to beat the market. Doesn't mean they always can. Doesn't mean they will. Doesn't mean they won't either. But most typically don't beat the market. So a lot of people say, well, I'm going to invest passively, where they're just buying, let's say the S&P 500, which is the 500 largest U.S. companies, and they're going to ride it out. So if it goes up 10%,
Cool.
we're getting 10%. If it goes down 10%,
Boo.
ooh, there are no triggers for them to say, oh, we're going to pull back, we're going to go to cash, we're not going to do anything else like that.
It's just riding along.
So generally, mutual funds or active managed ETFs even tend to be more expensive. Passive ones tend to be cheaper, but over the long haul, passives tend to do better. I think I saw reports like 9% of active managers over 20 years actually beat the index. So you have a very low odds of actually beating them.
Wow.
But it's kind of, I mean, we can nerd out on this, but basically, generally, really solid areas like the U.S. where people have a lot of information, they tend not to beat them. But emerging markets, so if you're investing in like, Indonesia, though that's where active management can be more helpful because they can do more research than you and I would be able to do
on our
so
own.
there tend to be more value with like the smaller companies or the very obscure kind of countries that you're investing in compared to like everyone knows what's going on in the U.S. There's no hidden secrets anymore.
No, yeah. So stocks. So you can buy individual stocks, you can buy groups of stocks.
Correct. Yep.
And that's a company.
So yeah, you're either buying a collection of companies or individual companies.
Okay, so here's a stock. Now, what is a bond? Because again, stocks and bonds are one word as far as I'm concerned, and people just think they're the same thing. Stocks and bonds are one collective thing that you're getting.
Okay, so you're in the mortgage industry, Kelly, right? So let's use the mortgage as the example to explain this. So when you buy a house, do you have $1 million or let's say $500,000 at the ready of cash?
Nope, people do not. So they go to the bank, and the bank gives them the money.
Yep.
Lets them borrow it for interest.
Yep. You give them money every month, right, to pay the debt back. Basically, you're doing the same thing. So let's say a company like Apple wants to build a new factory back home here. They're going to say, hey, Kelly, I'd love some money. We don't have all the money available to build this factory. We'll give you money. If you give us some money now, we'll give you, let's say, 5% a year of that money that you give us. And then at the end of the term, so let's say we'll pay you the money back in 5 years. At the end of 5 years, we'll give you your money back. So most bonds are sold at like a par value, which is $1,000. So we'll give you $1,000 back at the end of favors. Sounds pretty good. I get 5% along the way, and I get my money back. So bonds tend to be safer than stocks because you get that coupon payment coming in every year. You're typically investing in $1,000 or whatever you end up buying for bonds. But there are still risks associated with bonds. For example, interest rates, right? We've seen over the last year and a half, they've moved pretty tremendously, right?
A lot, very dramatically.
Yeah. So let's say you and I, you bought a bond paying 4%, and then the interest rates going up. Now the bonds out there in the market are paying 5%.
You're stuck with your bond only making 4%.
Like, oh man, there was one right over there that's paying 5%. So the value of your bond, you're still getting your 4%. You're still going to get your money back at the end of the term, but there's better bonds out there. So the price value is, so if you try to sell it halfway through the term, you're going to get less than typically what you paid for the bond. So there's risk there. And then if conversely that happens, you had that 5% bond and now interest rates drop again, you're like, oh, there's all the new bonds are only paying 4%. Well, that's not as good. So that's called reinvestment risk, right? But there's also default risk for companies. So if you buy a bond in a company that has really terrible financials, or you're buying Prestige Worldwide, right, and is definitely not going to make it, you could lose your bond, right? So there's the
and
company
then the
risk.
money's gone.
Money's gone. Yeah. So same thing. So it's not like there's zero risk with bonds. They tend to be safer, but there's no risk. Plus the other thing is inflation. So if you're getting a bond that's paying 1 or 2% and inflation is 3 or 4%, you're losing 1 or 2% every year.
Wow. Now, are bonds like stocks in that you can buy a bond, or are you buying a collection of bonds, or can you do both?
You can do both. So you can buy individual bonds. So you can buy an individual municipal bond. So if you want to buy a bond for the town that you live in, you can do that. If you want to buy a bond for a specific company, you can do that. Most people tend not to because the bond market's a little weird. It's expensive to buy an individual bond. And then also, just generally, it's just easier to buy a collection of bonds and get a whole swath, because then you can spread out your risk too. You're not just relying on one company defaulting. You can have different buyout periods, a duration we call it, where you set up your basically average length of term of your bonds. Plus, with an individual bond, if you want to get out halfway through, there's some of that price risks. There's some of those other things, liquidity risk with the bond. So you may not have a market for the individual bond, but almost everyone's going to be buying back an ETF.
An ETF, so it makes more sense. Now, as an individual consumer, right, we're always thinking along the like 401k lines. And we always pick on
Yeah.
I pick on 401ks on our podcast, and just that it's what everybody knows, right?
Mm-hmm.
Because you get your first job, they're like, do you want the 401k? And you're like, sure. And a lot of people just don't go above and beyond that, right? I
Yeah.
got a 401k, that's my retirement. Where do stocks and bonds fit into like an overall retirement plan? Are these part of 401ks? Are these separate from them? Should you have both? Like, what does that look like?
Yeah, when it comes to the 401k plan, almost no plan offers individual stocks. I mean, I'm saying some plans do, but it's a separate brokerage account. It's like a whole thing. Or a lot of companies will incentivize you to buy their
own stock.
Their own stock. Oh, yeah. If you work at the Hartford, for example, you could buy the Hartford stock in our plan. Cool. Not necessarily the best thing, because we saw with Enron where a lot of people were forced to buy, or not forced, but were really heavily incentivized to buy Enron stock. And
So not only did they lose their jobs, but they also lost all their investments.
A ton of money, right? So that's not a good situation you want to be in. So generally with 401ks, most options are bonds. Most people default to the target date fund, where they're just saying, okay, I don't want to manage this at all. Here's my money. And then someone's out there is picking their mix of stocks and bonds for them based on a retirement date 20 or 30 years out in the future, right? But so in terms of retirement in general, I think you want to have stocks to build wealth. So a lot of this comes down to, my opinion, like a time frame.
Like what is this? Where? How long until I need this money?
Yeah, what's the purpose of the money, right? Because when we look at it, there's risk with stocks, because stocks can have a pretty big risk range from year to year. So for example, they may be up 50% one year, but it may be down 50% in another year. That's a huge range of returns for a year. And like we use an example, you're saving for a home. Do you want to lose 20 or 30% of what you have saved for a home? Say with $100,000, do you want to be at $70,000 when closing's a week away?
No, that can really hurt.
That would give me anxiety, right? So if it's my general rule of thumb is if it's 2 years or less, you want to be basically cash. So,
in cash, my friends, because I'm going to say this as the mortgage person, this does not mean dollar bills, y'all, under your mattress. This is just money sitting in a savings account.
Savings account, high yield savings, checking. I would probably lean to the high yield savings if you've got some time. I mean, if you want to go a little crazier and have some in CD that is going to expire in the time frame that you need the money.
It to, yeah.
Go that route. But anything over that, because generally a 20% drop in the market will take 20 months to recover.
Yeah. So if you think, right, I need this money in the next 2 years, we're saying generally 20 months to recover. We don't want to be in that situation,
right? Because if it's worse,
right?
You're not in a great spot. So it's very important to really line up your investment objective with the investments.
Yeah, and you have an interesting kind of concept about like what sort of money you need to do what activity and like where that money should be. Can you talk about that a little bit?
Yeah, so I call it like the Bill Belichick philosophy. It's like his whole phrase was "do your job." Like, what is the job of this money? Right,
so where am I going with it? What am I doing?
Yeah, I mean, so generally, if you're younger, you're 25 years old, you're 30, and you've got 35 years of retirement, like you should be in stocks. You should be mainly in stocks. You shouldn't be, that old adage is own your age in bonds. I hate that one. Don't ever do that, because if you're 30, that means 30% of your portfolio should be in bonds. It's way too conservative for a retirement account, because over the long haul, stocks have averaged a much higher rate of return typically than bonds. I have some stats here. I'll kind of show you the difference.
Stats.
So I looked at just basically 3 time frames. So since 1928, right before the Depression, stocks averaged 9.8% per year to 2023.
That's nice.
From 1950 to 23, it would average 11.13% rate of return.
Also very nice.
Very nice. Yep. And then from 2000 to 2023, it averaged 7.71%.
Well, that's because we had some drama in that period of time.
Well, yeah, think about it. We had the tech bubble. Then we had 2001. 9/11 happened in 2001. Then we had another down year in 2002. And then finally started to get a little bit better. And then bam.
Boom. The mortgage industry fried the economy in 2008.
Yeah. Stocks were down 57%.
Whew.
So we take those things into account.
That rate of return is pretty good.
Yeah, plus 2022, and you still were up 7.71%. So that shows there's some volatility there with stocks, but if you just stay with it, you're up.
Which is the general rule of thumb with the stock market.
Yeah, and that's where time frame matters, because if you were saving for the house in 2007 and you want to buy one in 2008,
yeah, if your money was in cash, you were fine. If your money was sitting in stocks, you just lost half your down payment.
Right, exactly. Now, conversely, bonds, those same time frames average 6.68%, 6.95%, and 6.35%. So definitely a much tighter window of returns, but definitely not as much. So that's where asset allocation really comes into play. So if you're younger, I'll just kind of throw the numbers out here. So if you invested $1,000 starting in 1928, you'd have $7.87 million.
From $1,000.
From $1,000 and not adding anything extra into it.
Wow.
I mean, that is a long time frame.
Yeah,
no one's going to invest for 100 years.
Correct.
Most babies aren't investing. But let's say you did it from 1950, so still a pretty long time frame, 70 years plus. It's at 2.9 million basically
From your $1,000.
from your $1,000.
So think about how much your money's working for you right there.
It's doing a lot of work for it. And then going from 2000, so 23 years, doesn't sound crazy, but it's worth $5,000, 5,023.
But still, $1,000 to $5,000, that's a good rate of return. It's not 7.7 million, but in a significantly shorter amount of time.
No, but that's the magic of compound interest because a lot of it happens on the back end. So you really want to make sure you have the time in it. So if you're thinking, hey, am I going to retire now? Or hey, should I start saving now? Like save as early as you possibly can because that's when the magic's going to work for you. Now, conversely, if you're looking at bonds, you're looking at 495,000.
So way less.
So a little more than 7.4 million less, basically. 140,000 starting from 1950 and about 4,500 from 2000. So similar returns, but that just shows you the longer the time frame you have, the more you should be into stocks.
Now, for someone who's kind of looking at stocks and bonds and where they should be putting their money, it really does come down to timing then. It's what does the timing look like? And I think that it's been a bit of the millennial trap is a lot of us, right? We graduated either somewhere between the 2000s of recession number 1 or the 2008s of recession number 2, and kind of getting a good job and getting money underneath you and stuff like that has been really hard. And a lot of people aren't necessarily investing. They might be putting money in their 401k. It's probably just whatever the minimum is to match. And here we are now. Most millennials are in their 30s at this point. If not, I'm an old millennial and I'm 41. But retirement isn't looking as far away anymore.
No, it's you can see the light at the end of the tunnel. It's there. It's not big, but it's there.
It's there.
Yeah.
And if you haven't started yet, or again, you've only been just kind of putting in the minimums, you may not be prepared for this.
Well, I think that's where we're in the spot now, the age range where our parents are retiring. So we're getting to see what it's like
Firsthand.
Yeah. Oh, did they save enough? I had a call with a Gen Xer, 2 weeks ago, and she basically feels like she has to take care of her mom because her mom is bad with money.
Yeah, and that's a story that a lot of people tell. And I see that on the mortgage side with more and more people are buying multi-generational housing. That's kind of coming back in vogue again. And it's coming back in vogue for 2 reasons. Is number one, the cost of living is so high that it's easier if you pool resources. But also there is a pattern right now of millennials moving their parents in with them because their parents were not prepared for retirement.
Yeah, I mean, and the biggest problem is they just didn't save enough because they didn't think of inflation, or they thought, I'll just put some money in my 401k and that's all I have to do. It's very simple.
Or they got in the pension trap, and I think that's one of the benefits of being a millennial is that we never had the opportunity to really get into the pension trap because very few of us had pensions or the ability to get one. So you kind of knew you had to take care of yourself.
Right.
So
yeah, we kind of started out at the gate saying, all right, I know I need to put money in the 401k plan. I know I have to save money for retirement. A lot of people don't know don't know the right mix of their stocks and bonds. And to me, that's the probably the biggest part is the asset allocation piece of it. But, I also like to look at, having a job for having a philosophy for how you invest, right? I think, do your job is the one probably overarching thing. That's where you want to start with. But I think after that, allocation is really important because these are all things you can control at the end of the day. Like I can't control anything that goes on economically. I can't control what presidents do. I can't control what interest rates happen. I can't control if there's a war in Ukraine. That's all going to affect the market, but you can't do anything about it anyway. So those two things are important. And then time in the market versus time in the market. I mean, how often do you check your accounts, Kelly?
My God. So I'm one of those people where I'm banned from checking my accounts. It gives me anxiety. So I'm someone that, when I see the ups and downs of the markets, and I'm a little bit unique in that I'm like a commission-based person. So each dollar for me represents a transaction. So if, I lose $3,000, that's a whole transaction that I worked on, you know what I mean? And so it gives me a lot of agita. So I'm at the point where my husband, and I'm very well versed in my retirement. So not to say that everybody should be, don't put all your eggs in a spouse or a partner's basket to be in charge of it. You should know, but my husband sort of updates me once a month and tells me how we're doing, because if not, I would drive myself crazy. But we also have a great situation where we have people we trust helping us with our money, and you know what I mean? So we feel really good about it. But I do think people can drive themselves crazy by looking every day. And I have a friend who, in 2020, when the markets initially sort of dropped, pulled all her money out, right? Pulled all her money out and hasn't put it back in yet.
Oh, the market was only down for like 6 weeks too. So it wasn't even a long time frame. Yeah, I mean, that's a challenge. I think I was telling you earlier. It was, I was waiting for a meeting with a lawyer, and I was talking to the person at the front desk, and she said, I got out in 2008, like right before the crash. I went to cash. I'm like, that's awesome. I'm like, when'd you get back in? She's like, I haven't gotten yet. And that was 2013. So it was 5 years and she still had not gotten back in. And that's the real challenge with timing the market because you have to be right twice.
Yeah.
Like when do you get out and when do you get back in? And most people just don't get back in because there's always an excuse not to invest. Oh, there's, if you're looking back at the last few years, right, we have, inflation's too high.
Yeah, there was a pandemic. There was
pandemic.
a
there's
war.
Yeah.
There's
interest rates are going crazy. I'll just save in a money market account. When if you look over the last 3 years, like the investments have crushed money markets accounts, right? So you just really want to make sure you're just kind of avoiding the noise, right? Because all it is in the short term, stocks do move on the noise, but over the long term, they're just looking at revenue. They're going to look, did you make more money than last year?
Well, I think the other piece to it too is having people that you trust. And I think, probably one of the hardships of millennials is a lot of times we do have parents who are semi-knowledgeable, enough knowledgeable to get us in trouble, but not enough knowledgeable to get us out of trouble. Is if you watched Boy Meets World, okay, or you know what TGIF stands for, you should have a financial advisor.
That's a good way of saying it, yeah.
If that is your age range, you should, now, truthfully, everybody should have a financial advisor from the young 20s getting out of college. But if you are in that age range, right, millennial age range, and do not have an actual person who you can call and ask questions, who can guide you through making decisions on where your money goes, you really need a financial advisor. Because just because your dad did it or your friend does something or there's a plan that works for someone doesn't mean that it's going to work for you.
No, I actually, I really hate family advice.
We also hate that in mortgages.
The problem is they apply their individual situation to you, and it never works. I'll give an example. Even with my father-in-law. So my wife's mom passed away. So with Social Security, they used to have this thing called file and suspend. So if you were married, you can collect on one, and then wait let yours grow up, and then collect on the other one later on. They got away with that a few years ago.
Yeah.
So my wife's uncle told my father-in-law and said, "Hey, you can't collect on the Social Security. You can't do the file and spend." But it's different when you have a deceased spouse. When you have a deceased spouse, you can do that. So it cost him over $2,000 a month to not do that. So I'm like, just do me a favor, call the Social Security. He goes, I called them on Monday. You're right. I'm collecting an extra $2,000 a month now, and now my Social Security can grow along with it. So like family advice is usually generally awful. It's with like good intentions, but I've just seen too much of it where it's way off the mark and it doesn't apply to your individual situation.
That is mortgage life right there, Derek. That's my mother's brother's friend got a 3.5% interest rate, and I don't understand why mine is so high. I'm like, your mother's brother's friend has an 800 credit score, put 75% down on their house. Like there's a whole scenario that's not yours.
Yeah. And
I think especially when you're talking about retirement, there's not a single person or family like yours financially out there. 0%. There's no one who matches your exact financial situation, your rent, your car payments, your student loans, your income, what year you want to retire, what state you're trying to retire in. There's not another person who completely matches yours. Therefore, the strategy that you need to retire is completely unique to you and your situation.
100%. And we're at that unique age where, okay, we're still on the upswing in terms of making income, but we're doing much better than we were hopefully, than we were 22 years old, right? So we've got some money. A lot of us now have kids, so now that's a whole planning mix, and they've gotten incredibly expensive.
Oh
so
my God.
Figuring that out, figuring out college, figuring out how to retire, and figuring out still how to actually enjoy your life because, hey, we're still in our 30s and early 40s, so I think we still want to have fun. I'd rather have fun now than when I'm 80 years old.
Go on vacation, those sort of things. Well, and I like your sort of concept about having the right money in the right places and knowing where your money's going, right? And I think a lot of people think, well, if I get put on a budget, I can't do fun things anymore. I can't go on the vacation. A budget automatically means I can't spend any money. And really a budget is just knowing how many dollars are going to get spent towards what category.
Yeah, I think I heard this phrase a while back. It's like restriction creates freedom.
Ooh, right. I like that.
Well, because it's not restrictive because you're not like saying I don't have money to do this. You're just knowing where things are allocated, and when things are allocated correctly, you have the freedom to do other things. Right. So if I know, like all the time, anytime I have a client meeting, like, all right, what's the fun stuff you want to put on the docket? What are we adding on here? Vacation fund? Cool. So we know we need to save $200 a month to get to your vacation. All right, great. So that's your fun stuff, right? So we're putting it into the plan. So if we save for that first, anything we have left over, just go ahead and spend because we know we're on track for retirement. We know we're on track for your vacation. We know we're on track for, I don't know, you buying gifts for the kids every year. Like whatever the thing is, like just set an intention to it because that creates the freedom from it.
Oh, I love that. And I think that's, I see the other side to that with the mortgage piece where I have people who are like, oh, we make whatever, $250,000 a year as a couple. We want to buy an $800,000 house. And you're like, that math should math.
Yeah.
But then when you look at somebody's actual finances, the math doesn't math.
Right.
You're like, hey, you've got $1,000 car payment, an $800 a month car payment. You've got, $120,000 in student loans, and that's another $1,000 payment. You guys historically have gone on a $15,000, vacation every year. All of a sudden you whittle away all the money. And I'm like, you can't afford a home that price. And people are often shocked. I also think that's a little bit of the detriment to us as millennials in that we're the debit card generation as well, is that we don't balance checkbooks, right?
Right.
We get a debit card.
I don't think I ever have.
Yeah, I never. I remember like having the passbook, where you like filled it out, and I think I stopped doing that when I was like 18. We have debit cards. We swipety swipe at the swipety swipe, and the magic money goes in and out, and you check your account on your phone every once in a while, and you don't always know what's in it. And
You're
I think,
yep, I did that. Okay,
yeah,
that makes sense.
We're good. I know I've got this much money in there, so I'm good to make the swipety swipe, but we don't always like add it all up. And I think that's the greater arching kind of conversation here of having an advisor, knowing what your plan is, knowing where you're going with this money. What are you doing with it? What age do you want to retire? How much money do you want to live the life you're going to live? And I think, taking things like Social Security out of it. We don't know that we're going to have Social Security, millennials. We don't know that that's going to be an option for us. I know we're all paying into it and we think we're going to get it, but you can't plan on that as one of your retirement pieces. So you really have to be having these conversations with a professional now to make sure that you can retire at 65 or 60 or 70 or whatever you want that number to be.
Right, and that's kind of bringing it back to the investing. That's why investing is so important, because if you're doing the right accounts for the right goals, you're going to be aggressive with your investment or your retirement accounts, because I've got 30 years. So I know I can be invested. So now I know I'm earning 9% versus 6%.
Yeah, because the math has been done for you.
Right. So that says, okay, well, maybe I can retire a couple of years early because I'm investing correctly. So it's like that's the power of actually investing and aligning your investments with your goals. But to kind of get back to the last two kind of philosophy things is, we talked about time in the market. Diversification is a huge piece of it. So that just means don't put all your eggs in one basket. I haven't heard that phrase, but like, what does that actually mean?
So it means I can't have all Disney stock?
Yeah, just don't do all Disney stock, or even like common phrases I hear, just invest in S&P 500. That's it. That's all you have to invest in, because it's the 500 largest U.S. companies and we're the best. Where that has worked over the last 10 years, if you look at the decade of the 2000s, has done very poorly compared to some other options, right? So when you're comparing to the emerging markets or developed markets overseas, that was not the best spot to be in. Even, some gold will be the better spot to be invested in. So we really want to have a nice mix of it, because the analogy I use is, think of an ice cream parlor. You're not just going to have vanilla ice cream, right? You can have chocolate.
Yeah, mint chocolate chips and black raspberry.
Right. And then, guess what? It gets cold in New England. So maybe you want to have hot chocolate you serve. So it's like different seasons will have different demands, right? So the same thing will happen with stocks, and different stocks will do better in different types of markets. So you want to have a nice blend there. And that's something you can't control, right? Have the right mix for yourself. And the third thing is taxes.
Ooh, taxes.
Yeah.
I hate those.
Yeah, they can slowly erode your wealth without realizing it, because, if you have an investment account, you're going to get a 1099 every year, right? And then now that means your return is going to be a little less, like you're right, because everyone gets their tax return, they get their big check, and they're all happy about it, but they don't look at what really goes into that. And, if you're losing $1,000, $2,000, $5,000 a year to taxes in your investment account, hey, we could be more efficient. Like the simple analogy I use is with mutual funds. Not analogy, but example. Mutual funds. So if you buy a mutual fund in November, you actually incur the entire tax liability for the entire year for that mutual fund.
Yeah, so if you're going to be investing in November and you're using a financial advisor who knows about this and understands how this works, maybe that isn't where they'd put you in November.
Right. Maybe you don't want to go to a mutual fund. Maybe you go to an ETF, because ETFs don't have that problem. So like tax location really matters. Like, the thing I always talk about is like, if you have milk, you're going to put it in the fridge. You're not going to put it in the pantry. Right? If you have crackers, you're not putting the crackers in the fridge, right? You're going to put them where they should go. And different stocks, like for example, will be more efficient like an IRA, right? If you invest in real estate, they have a lot of payments. They're going to be treated as income. You want to have those in qualified accounts like IRAs and Roths. So you want to have growth stocks, which don't pay dividends, probably investment accounts. So you really want to have the right tax treatment for the account and really look at that, because that's a kind of a slow wealth eroder as well, without people really realizing it. And if they're actively trading their account 100 times and so there's a lot of different things they could do to help, improve their wealth through investing, just on the things they can control.
And if that all sounds confusing to you, especially on the tax front, this is where having professionals in your life is incredibly important. You're not necessarily supposed to know all those answers, right? As a consumer, you don't need to be the expert on that. Your dad isn't the expert on it either. Your dad's brother isn't the expert on it. Like, this is where you're using a professional because, like, Derek, that's what you're trained to know about.
Yeah. I look at those statements all day. I could see, oh, wow, that's a lot of interest. Like I had a situation with a client where they had a lot of, non-qualified dividends, which get paid at an income tax rate. And that's just because he wasn't holding on. I could tell that from his tax return. And I said, are you holding on to these stocks or are you churning them? He's like, I'm churning them pretty frequently. And I knew that from looking at his tax return.
Oh, and just one quick fix.
Because he was like, how did you know that? I'm like, I looked at your tax return. It says this is what you're doing to it. He's like, oh, okay. So there's a lot of little things that you don't think you're doing. You're like, oh, I'm making money because I'm buying and selling these stocks and blah, blah, blah. But if you're getting dividends and not holding it long enough, you could be paying a lot higher taxes because of it.
At the end of the day. So what's sort of the message here, right? Is that number one, you don't need to be an expert on this. This is what professionals are for. Number two, set it and forget it 401k is also not the answer.
No, I think you need to have a blend too, because the one problem with 401k is you're punting that money for the future. That's just for retirement. You want to have some money that's in between to deal with any other opportunities that may come up or issues that may come up or just having flexibility in general. So you really want to have a nice blend of accounts. But I think really you just got to figure out like, okay, first question is what is the job of this account and align that correctly, right? And if all of this is way over your head, hire someone. 100%.
That's what professionals are for.
Yeah. But if it's not and you feel like you can do this yourself, yeah, I mean, broad-based ETFs typically work. Set it and forget it.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.